Sky News Business, your property empire.
Hello and welcome to Your Property Empire. I'm Chris Gray. On tonight's show, do you get an automatic tax deduction when you redraw money against your investment property? What are the top tips and traps when managing deductible and non-deductible debt? And does the last 12 months house price data tell us, what does the last 12 months house price data tell us about the market? Well, joining us tonight is Rob Southwell, Managing Partner of Pitcher Partners Accountants and Advisors, and Charles Tarbey, Chairman and Owner of 2021 Australasia. So, Rob, when investors go to refinance their loans, what are some of the important things that they should be thinking about?
I think the most important thing is to get the integrity of the loan structures right first. So by that I mean, and we'll talk about it a bit more in a moment, about keeping, if you have deductible, non-deductible debt, for an example, keeping them separate. And then I think the next thing that people need to consider is the type, whether they're paying interest only, P&I, and then the relevant interest rates that they're paying. So from a cash flow perspective, you want to consider, for example, with an investment loan, usually people try and stick to investment interest only, and then if they still have non-deductible debt, to be able to pay that down as quickly as possible, so getting a lower rate on a home loan on a P&I basis as well.
And do you want to explain P&I, because obviously in the industry we jump around with all these things, but not everyone understands that necessarily.
Yeah, sure, it's pretty straightforward. Principal and interest means that you are proportionally paying down a small amount of the principal amount that you've borrowed in your repayments every month, and interest only is you're just paying back interest. So it's really just to be flexible in your cash flow.
Oh, I thought it meant profit and income for the banks. P&I, what's going on?
Now, Charles, obviously, if I ask this question to Rob, he's obviously going to say yes straight away, being an accountant. How important is it for people to get this advice up front? Because the average person tries to save money on accountants, they set up their home loan, and then 20 years later they realise they could have done something different.
It is very important to get advice up front, but it's always even more important to get that advice from the right person. You see, not everybody, not even real estate practitioners or accountants or lawyers, have actually experienced property acquisition themselves. And I find it really interesting that people give advice on purchase of property when they actually haven't had any experience in those forms. And that's the thing that concerns me the most about. It's not about getting advice, it's about getting advice from the right person.
Yeah, because the average person, they're going to get it from their friends at the barbecue, or just because they're a real estate agent doesn't necessarily mean they know what the best investment is.
You know, that's true. Getting advice from a professional person that's not had the experience, you've got to get it from that right person, because it's gold, Chris. It's gold information when you get it right.
Now, Rob, when people have got a mixture of deductible and non-deductible debt, and especially when they're on their own homes, they might pull a deposit out from their equity to then go and buy an investment property. What are some of the pitfalls that, if the tax man does come knocking, and quite often he will come knocking at some point, what are the pitfalls around that?
So the most common pitfall that we see people make is that they end up blending deductible and non-deductible debt. And the easiest way to visualise this, I tell clients, is to think about two buckets of water. So you've got one deductible, one not non-deductible. If you have a third bucket of water and you pour a little bit of deductible and non-deductible into that bucket, you can never pull them back out. And that's the way the ATO interprets it. So once you start blending your debt, you will always lose a percentage of your non-deductible amount when you repay it, because you've got to repay it proportionately. So what you need to do is to have very, very clear separate loan accounts for deductible and non-deductible debt, so that you can show that you're clearly paying one off as opposed to the other. So a lot of people get that wrong, particularly when they're in a hurry. They need a deposit because they walk past a house which was going to auction and then need to write a cheque real quick. You can actually, you know, I call it taint your deductibility of interest depending on how you do it. So it's really important to structure them separately.
Yeah. Now, Charles, it's obviously important to get everything tax deductible from the right kind of perspective, but really real estate should stand up on its own whether or not you get a tax deduction, shouldn't you?
Well, it should, but, you know, it's under a fair amount of pressure at the moment, because varying politicians might suggest otherwise. And I've never seen property as anything other than normal business. I mean, I do work on a property that I own. I do some capital work. I expect that to go against any capital gain. I have negative gearing. I expect that if I'm losing money, that some way I get a tax deduction. And I think those are the areas that are really under threat right now. There are parts of the world, countries around the world, that don't have negative gearing. Now, I'm concerned that if negative gearing disappears, then the investors are disappearing, which they are now, because APRA's, what they've put in place is 5 finally starting to kick in. And so therefore, who's going to provide housing? Where's that housing going to come from? And traditionally, government bodies have not done a great job, which we talk about all the time.
And certainly in the UK, there's been major changes over there about, first of all, no negative gearing, but also even being able to deduct your interest on the loans.
Yeah, well, that's
which is pretty major.
They've already started with, you know, and there were some people taking advantage of interstate travel to go and look at their properties. So they've already started little things like that, and rightly so. But where's that going to lead?
Yeah, and obviously people buying a property just because they can get a free holiday to the Gold Coast probably is the best investment criteria. No. But were there some other changes in the tax budget that made a difference?
Yeah, so last May they introduced a range of changes for negative gearing, and I think what they were trying to do, because they didn't want to get rid of negative gearing, but they want to have better integrity in their negative gearing structures. The first one, obviously, which Charles has meant, is removing a deduction for travel, so I think that was probably fairly being abused, so to remove that is probably fair enough in the scheme of things. I think probably the biggest change, though, is around removing the ability to claim depreciation on plant and equipment that you didn't otherwise buy. So if you buy a property that has plant equipment, you know, the kitchen stove and those types of things that you would have otherwise got a deduction for, if you didn't actually buy them yourself, you can't claim a deduction for that moving forward.
There was an interesting question asked. I was talking to Peter Switzer on his radio show the other day. There was a person rang up and said, look, I want to meet my property manager. I want to find out what their office is like, how they work and so on. So when I'm flying down to Melbourne to meet these people, should that not be tax deductible? And it was a genuine request, and of course it may not, they may not be able to do anything about that.
Yeah, and I guess that falls in the vague area. I mean, they use the example of, it's, you know, if your property manager, you pay your property manager to go and do it for you, that may be, but I think the problem was that people were going to the Gold Coast. It just so happens they have an investment property up there and claiming half their holiday as a tax deduction. So I think it's also important to remember, though, they've grandfathered that. So it only applies to property that you've bought post-May this year, so it doesn't automatically deny you deductions that you would have already had, so I think it's important to...
Well, certainly we'll jump to some of those things, and I want to touch on some of the lending criteria, but to make sure we make the most time out of you, Charles, let's jump into your property stats.
Thank you, it's very kind of you.
So we'll start off with the clearance rates.
A very interesting week. Still Sydney's under a little bit of pressure with the way it's been going, but the clearance rates across the country, they dropped to 66.5%. Now, this time last year they were 77.5%, so that's an 11-point drop over the 12-month period. So that's giving you an indication something's going on. Sydney came in at a very low 64.4, but again, that compared to what it was like, but that is still a very good clearance rate. Melbourne came in at 71.4, but the leader this week was Canberra, 72.9. Now, Melbourne had 1,299 auctions and Sydney had 1,089 auctions. Canberra only had 126, but still, that's a really strong clearance rate for Canberra.
And in terms of the drop between last year and this year, do you think that's enough to cool APRA down, that they'll be worrying less about this boom and may chill out with the banks a bit?
I do think once Melbourne starts to feel that negative part that Sydney's just been going through now, I think when that happens, they'll probably feel a lot better about things.
And what about homes advertised for sale?
We've had quite a number of weeks of stock coming in. I know it doesn't come in all of the areas. I know it doesn't come in some of the areas you want to purchase in, but 1.65% increase this week over last week. And this has been like a really strong increase week after week. If you look at the chart, it's almost like Mount Everest from where it was. It's climbed so quickly. So I think that and the auction clearance rates mean something. The two together mean something, and people need to start watching that very closely.
And how about the rent price movements?
Yeah, they have been pretty good in some parts. So I was interested with Hobart. Last week it went back 2.11%. This week it's recovered, coming back up 1.08%. But the star performer for me is Perth, because it's just been slowly going up and down and moving around instead of crashing all the way. And it had a plus 0.24% increase. But overall, across all the capital cities, there was a 0.69% increase.
Okay, and finally the vacancy rates.
Yeah, well, you know, the two capital cities that have been performing the best have always been Sydney and Melbourne. Pretty tough on tenants. Melbourne, again, star performer, has been for weeks and weeks on end at 0.84%. Sydney came in at 0.96%, still under 1% vacancy rates, quite enormous. Perth, one we watch very closely, has been hovering in the mid-sevens for a while now, which is great, and watching the rent move. It came in at 7.65%, so the three capital cities combined with 3.15%, and that's down considerably on this time last week, which was 3.65%. So.
A lot of numbers, Charles. Very good memory. Very, very quickly, you mentioned that APRA may call down with the banks. How long do you reckon that might take before there is any change?
I think we're starting to see it. Starting to see it already, and the banks, the RBA, are talking differently. The RBA are giving you that indication interest rates may start to come up. Economy's good, everything's great.
Wonderful. Thanks as always for...
I'll shake your hand next time.
You can shake my hand, Charles. Good to see you. Anyway, we're going to take a short break. We'll be back soon. You're watching Your Property Empire.